India's green hydrogen sector is gearing up for a massive expansion by 2026, creating wealth generation opportunities that look very different from legacy fossil fuels. This stacked chart breaks down the $5 to $10 cost of green hydrogen. The bulk of that expense comes from electrolyzer capex and transport. To become commercially viable, the industry must compress those two costs down to $1.50 per kilogram. Many retail investors see that target and immediately buy shares in large established oil and gas companies, assuming these transition giants will capture the upside. But those legacy companies face a difficult reality. They deal with highly complex land acquisitions and severe swings in global commodity prices, which drastically prolong the gestation period of their green energy projects. When projects sit in the pipeline for years without generating revenue, they act as an anchor, directly dragging down the immediate return on equity. To pay for that prolonged long-term capital expenditure, management has to divert traditional dividend payouts, which leaves retail investors holding stocks with stagnant share prices. Buying legacy energy stocks simply to get hydrogen exposure is a trap. The actual wealth generation will happen within the specific companies that are actively engineering solutions to those electrolyzer and transport bottlenecks. The Indian government recognizes these hardware bottlenecks. That's why they are injecting 19,000 crore rupees into the sector through the National Green Hydrogen Mission. This capital is being distributed through targeted programs like the SITE scheme, which require winners to hit strict benchmarks for indigenous manufacturing, a requirement that favors specialized hardware providers over broad energy conglomerates. Consequently, a significant portion of this funding is flowing to agile, mid-cap engineering firms and unlisted deep tech startups that hold exclusive intellectual property. That leaves you with a difficult choice. The companies solving the core hardware problems hold high growth potential, but they often operate in highly illiquid or unlisted markets that are hard to access. To figure out where to allocate capital, we need to evaluate the upstream technology bottleneck, starting with the current commercial baseline, proton exchange membrane, or PEM, electrolyzers. PEM is a mature technology, but its primary scaling hurdle is its dependence on extremely rare platinum group metals, specifically iridium. Relying on those rare earth metals forces PEM operators to absorb high upfront capital expenses and leaves them exposed to global supply chain shocks. We can compare that baseline to an early-stage deep tech startup called Newtrace, which is building a completely different hardware solution. This matrix compares traditional PEM systems with Newtrace's membraneless technology. Instead of fragile membranes, Newtrace uses 3D printed fluidic channels to split water. By dropping membranes, they eliminate rare earth metals entirely, shifting to earth-abundant materials and cutting overall hardware components by 70%. But investing in that kind of intellectual property comes with severe friction. Because Newtrace is currently backed by venture capital, it is highly illiquid and effectively locked away from the public market. Allocating capital at this stage means you also have to absorb profound experimental risk. The technology works in a lab setting, but it is still proving its ability to operate at commercial scale. While membraneless technology offers high potential for disruption, the extreme illiquidity and execution risk make it an inappropriate fit for a standard retail portfolio. That brings us to a middle ground upstream solver, operating in the pre-IPO space, a company called Insolare Energy. Instead of inventing a new membraneless system from scratch, Insolare licenses proven anion exchange membrane, or AEM, technology to bypass the vulnerabilities of PEM. AEM systems fuse the affordability of standard alkaline materials, like nickel and iron catalysts, with the high efficiency and current densities you normally only get from PEM. The friction here is liquidity. Investing in Insolare's unlisted shares requires you to commit your capital through strict lock-in periods, typically lasting 6 months after the company eventually goes public. During that lock-in period, your capital is fully exposed to market risk, specifically the intense margin competition within Insolare's legacy solar EPC business. Allocating to a pre-IPO AEM operator gives you a blend of proven execution and new IP, but it requires you to sacrifice your capital mobility during a critical phase of the energy transition. If we move past the upstream production phase, we hit the midstream bottleneck, physically transporting the hydrogen molecules to end users. The core physical limitation of hydrogen is that the gas aggressively embrittles standard pipeline steel when placed under high pressure. You cannot use normal pipes. You have to use highly specialized, certified X65 grade line pipes, which creates a high barrier to entry that favors certified public players like Wellspun Corp. This EY document outlines the primary alternative to high-pressure pipelines, liquid organic hydrogen carriers, or LOHCs. LOHCs let producers safely move hydrogen using existing tanker networks, but releasing it requires an energy-intensive dehydrogenation process that burns through 13 to 34% of the energy content. Because moving hydrogen is so technically difficult, whoever controls the certified transport mechanisms dictates the midstream market. Infrastructure certification acts as a protective moat that is just as significant as upstream patents. This decision tree maps out how you should structure your portfolio for 2026 based on two specific constraints: your risk tolerance and your liquidity needs. If your strategy demands daily liquidity and lower volatility, you should route your capital toward listed infrastructure pivoters like Wellspun. The trade-off is strict. You secure immediate exposure to established public market contracts, but you sacrifice the potential multiplier that comes with owning pure-play intellectual property. On the other hand, if you are a high-net-worth individual utilizing alternative platforms with a 3 to 5 year investment horizon, you follow a different path. You can target unlisted pre-IPO leaders like Insolare, securing an allocation before they execute on their massive accumulated order books. What you cannot do is screen energy stocks solely by their historical dividend yields. If you do, you will end up holding traditional conglomerates, absorbing their legacy capex burdens and missing the IP moat entirely. The transition to green hydrogen will move past the general hype and favor those who identify specific engineering bottlenecks and match their capital to the appropriate timeframe.